Hi guys, welcome to my video. I hope that you will find it helpful. If that is the case, then please subscribe and like so that we can keep this resource for free. Thank you. So let's have a look at cost and management accounting, sample assignment 3, question 5. That is on standard costing. And this is what they tell us. They say that VBN uses standard costing for recording transactions in respect of the manufacture of their single product driftwood lamps. First thing they give us is the standard and the budget cost. So what they're expecting is standard direct material per unit, so that is per lamp, is 25 meters at 165 Rand per meter. Must be huge lamps, that's all I'm saying. Standard direct labor per unit, it takes 18 hours to make one lamp, and we are paying the guys 55 Rand an hour. At least in this example, they're not paying minimum wage. It's a bit better. Then the standard variable manufacturing overhead per unit is 12 machine hours at 22 Rand per machine hour. So that is the variable manufacturing overhead. So all these things are important. You'll see now when I start doing it. The budgeted total fixed overheads is 250,000 and the budgeted machine hours is 12 hours. Okay, so that's all in the plan. Now we get to what really happened in January. They purchased material to the tune of 50,000 meters at 168 Rand per meter. Of that, they issued 48,500 meters to the factory. We look at the direct labor. There was 38,880 hours spent on making the lamps at 56 Rand 65 per hour. The variable overheads was 544 and 33 cents per unit. The total fixed overheads was 250,000. The actual production, this is really important, we're going to use that number a number of times, is 1,900 units. And then the machine hours is 12 hours as was expected. Okay. Now they say to us, calculate the following variances. Firstly, the material variances, the labor variances, and the overhead variances. Now, the first thing that I did here, just keep it in mind, I'm going to maximize this. It's really the same thing. So what I'm doing is I am taking all the information that was given, but I'm just breaking it down and putting it in separate cells in order for me to do the calculation. So there I have standard direct material, 25 meters per unit at 165 Rand per meter for a total of 4125 given. The standard direct labor per unit is 18 hours at 55 Rand an hour. So that gives me a labor cost of 990 per unit, but that was also given. The standard variable manufacturing overheads given as 12 machine hours at 22 Rand for a total of 264. Now I'm not sure if that was actually given. Okay, so in this case, you will see that I actually just did the calculation, because I want to see what is the cost per unit. That is the thing I'm going to work on, because in the given information, they give me the cost per unit, and I must be able to compare apples with apples. So then they give us the total budgeted fixed overheads. It is there, 250,000. And they give us the budgeted machine hours at 12 hours. Okay. Now we start looking at what really happened. Now this part is given. They say to us that we purchased 50,000 meters at 168. Now you can already see here, if you look at it, that 165 is less than 168. So we are paying a little bit more for our material than we expected. So if I take the 50,000 and I multiply it with 168, I get a total. Now, I don't know yet if I am going to use this total or not, but I'm getting the total so that I'm able to compare apples with apples. Because now I see that if I look at the materials purchased, it comes to 26 Rand 32. But that's not everything that was used. So that can actually be a little confusing. The material that was used is only 48,500. So that is really the amount that we need to put in there. Okay, now look at this. What did I do here? 5,000 meters. That is the real cost. Okay, we know that it is at 168.30. So in total, we spent more than 8 million on material issued. Now we can go back here again and we can say, okay, well, it won't make a difference. It will, I think it will still be, let me see, equals, what did I, sorry, lost my bearings here for a moment. Let me just see what I was trying to do. Yeah, this is actually a better measure than that 26. If we actually say, if we look at our total production, then we take our material used, and if we divide that by the 1,900, at least it's not as bad as 26, because the 26 is not true. What we are actually spending the money on here, sorry, that in there. Okay. So really, the material that we are using are costing us 25 Rand 53 per meter, or per unit, not per meter. Our direct labor hours, well, that was a total of 38,880 hours multiplied by 56.65. So I have a look at that. I see that my total per unit again is 20.46 hours. Now, once again, look at this. You can already see something happening here. 20.46, we planned for 18. The cost here, 25 Rand 53. Do we have that in there? No, we didn't. Material issue, direct material per unit, 25. Sorry, yes. So we expected 25, but now we're paying a little bit more per unit, 25.53. So it looks like we under budgeted kind of just about everything. Our variable overheads is given to us as 544 and 33 per unit. I'm just saying, you know what, let's see what the total was for the variable overheads. And then our fixed overheads, that's as far as I left it. So these little calculations here, I did them to start with, just so that I can compare apples with apples when I start looking at the variances. That's the reason. Okay, and then they give us these variances, the material variances, the three, the labor variances and the overhead variances, and they say to us, we must calculate that. And then if you look in the answer book, this is the way they give it to us. They give us as the name of the variance, and obviously we are just going to put in there what was asked. Then there is a formula, and then we must do the calculation and put down the answer. Okay, not a problem. We can do that. Now, these formulas are given in your textbook, but now so you can just put down the formulas as they are given. The only thing that I found a little confusing was the abbreviations, and so I decided to rather write them out so that it is easier to see what I'm looking at. Okay, so if I look now at the first one, the direct material issue price variance, it is the actual cost minus the standard cost multiplied by the actual quantity. Okay, so let's have a look at that. So the actual cost for direct material that was issued is 168.3. Let me just show you that. You see there, direct material per unit is 165.3. But here, when we did the calculation, we saw that in reality, it was 168.30. So that's why I didn't do that calculation in the first place, because it wasn't necessary. Okay, so that is the variance. We can already see we are paying a little bit more per meter. But I must use the things that compares apples with apples. Multiplied by the actual quantity, that is 1,900. So if I then do that, I get an answer of 6,270. And because we are starting with the actual and we minus the standard, if I then get a positive value, it means that the actual is more than what I planned. And therefore I now say that 6,270 is unfavorable. So in total, I'm saying that I spent 6,270 more on direct material than I planned. I don't want that answer in there yet. I'll put it in there. Now, if we look at direct material quantity variance, that was on price. It's much the same. We say, okay, let's have a look at our actual quantity. From that, subtract the standard quantity, and then we will get to the standard cost. So if we do that, sorry, this is what we get. We see that our actual quantity that we used per unit, if we go back here, see our actual quantity that we used per unit here. You see, I've made a mistake here, Derindri. No. See, that is why I do want that amount in there. So that's fine. I'm going to fix it. That is equal to 1,900 units divided by that. No, I'm doing something wrong. Sorry, can I just check here what I did? It was B15. I must do it the correct way around. It's equal to this divided by the hours. Okay, so that is actually then, as I thought it should have been, 25 Rand 53. Okay, so now if I go and look here, I say that my actual cost, see, I made the mistake when I initially did the calculation. I looked at what was purchased and I should have looked at what was issued. Okay, so let me just fix that. So that's not 26.32. That is indeed 25.53. So it's not that bad. 25.53. Okay, so now if I look at the answer, I must fix it here as well. 25.53. And then I get an answer here of 87 Rand 45. Okay, that is my total direct material quantity variance. So I'm saying, you know what? This is pretty good. I thought I was going to use 25 meter per unit. I'm using 25 and a half. Really, it has a very small impact, but nonetheless, it remains unfavorable. Why? Because the actual is more than more than what I budgeted for. Okay. Then I get to total direct material variance. Now here we look at the actual quantity multiplied by the actual cost, and from that we subtract the standard quantity multiplied by the standard cost. Now I'm obviously going to sit with the exact same problem here. This which was wrong, that is not 26.35, that is 25 0.53. Just fix it. That was the real cost. Okay. Or the real quantity that I used in terms of material at my price per meter, which was a real 168 Rand 30 cents. What I planned was 25 meters at 165 Rand per unit. So now when I do my answer, let's just fix this again. It's now 25.53. So what I get here as my answer is 171 Rand 70. So in total, if I look at it per unit, it is costing me 171 Rand more in material per unit than I planned. Okay, and that's of course unfavorable. I don't want to spend more than what I planned. Okay, so now we have looked at all direct material variances. Now we look at the two direct labor efficiency variances that they ask us. Now, please, then just have a look. The ones that I'm doing here and the ones that they ask you in your assignment are not necessarily the same. I think some of them are the same, some of them are slightly different, but all these formulas are in the book. You just need to know where to find them and how to apply them. Okay, so once again, let me just white this out before we have a look at it. Okay, so okay. Let's look at the direct labor efficiency variance. Well, once again, the formula, we can get the formula from textbook. It says it's the actual work time minus the standard work time multiplied by the standard rate. So now let's have a look at that. The actual work time, okay, is 20 hours and 0.46. It's not 46 minutes, but 20.46 hours. Okay. Is it? Yes, it is. And what did we plan for? We planned for 18. So this is the difference that we're looking at. So if we look at our answer, we will say it is the 20.46 minus the 18 multiplied by the standard rate we are paying these guys, which is 55 Rand an hour. Once again, the actual is more than the planned. So we are spending 135 Rand and 30 cents more per unit. And once again, that is unfavorable. If we look at our total direct labor variance, formula there is the actual work time multiplied by the actual rate minus the standard work time multiplied by the standard rate. Now, the actual work time, we already had it there. It was 20.46. We saw that we paid the guys a little more than we planned per hour. We paid 56 Rand 65. And what we planned was 18 hours at 55 Rand. So once again, we can see that our answer is going to be positive. What is it saying to us again? We are spending 169 Rand more on labor per unit than we planned. And once again, that is unfavorable. Now, if you look at the two together, not that it is asked, if you are spending, you're spending just about 170 here more on labor per unit, and you are spending 170 more on material than you planned. So in total, you're looking at about 340 Rand more that you are spending. Now, in this example, they don't give us the sales price or anything, but you must now actually say, you know what, whatever the reason was for my pricing decision, I must actually up my pricing decision by 300 Rand because my input cost has increased. If you now think of the taxi industry, okay, inflation is high, so they have the taxi owner has to pay the taxi driver more. So his labor cost per trip is going to increase. Petrol has gone up. That is material cost. So that is also going to go up. But now he's got to go and calculate this per trip That will be his unit, so that he can see by how much should he be raising his prices, so that he still makes at least the same profit, even if the margin might be lower. Good. Now, the next two that we are asked is the variable overhead expenditure variance. So once again, the formula is there. It says, what was look at the actual expenditure, and then from that, subtract the standard rate at the actual work time. Because that's where it's coming from. So let's see what's happening. So now we see we are sitting here with an amount of 1.034 million hour. Where did I get this? Okay, here. The variable overheads, they gave it to us as 544 and 33 per unit, but they also gave us the unit. So I can go and I can calculate my variable overheads. That's why I did that calculation from the start. So my true variable overheads is 1.034 million. Okay, good. From that, I must subtract the standard rate. The standard rate for what now? The standard rate that they gave us for the variable manufacturing overhead per unit. So that is the standard rate I'm using there, that 22. And I already know that I worked 38,880 hours in total. Good. So if I calculate that, I see that my total variable overhead expenditure is a full 178,000 Rand more than I expected. Well, why? If my direct material cost increased, I'm just saying there was cost increases that I under budgeted for. And so once again, it is unfavorable. The last one they want us to have a look at is the variable overhead efficiency variance. Formula is obtainable. It's actual hours minus the standard hours multiplied by the standard variable overhead rate. Because now I've just spelled it out so as you know which rate we are using. Okay, so having a look at that, the actual hours was given. The standard hours will be the amount of units that was given, the 1,900, multiplied by the 18 hours that we expected to take. And our standard VOH rate will be 18 Rand. Okay, now, where did I get that? There. Okay, that's my standard direct labor per hour, but it's also my, no, there's a mistake here. My standard variable manufacturing overhead per unit is 12. It's not 18. This is the one that I must be using. So I don't know. That was just a slip of the finger. That should definitely not be 18. It should be 12. Okay, and then when I calculate it, I must just fix it as well. Okay. So if I look at my variable overhead efficiency variance, I see that now it is 350,000 more than what I expected it to be. Once again, that is the real is more than the expected, and so therefore once again it is unfavorable. If ever you get a negative value, you will write it down as a positive value, but you will say it is favorable. Thank you for watching this video to the end. If you found it valuable, please subscribe and like.